Hey everyone, good morning, good evening. Thank you for joining us. And Really appreciate everyone here. Let me start with a quick introduction about us and about our guest. Um, my name is Hemant Gangolia, and I am the co-founder and CEO of NRI. Along with me is my co-founder Nishat Shah. We are extremely delighted to host you all today. I personally want to thank you for taking the time and to attend our tax webinar, especially on a Saturday summer. Before we get started, I wanted to quickly introduce INRI and ourselves. Personally, I moved to New York in 2017 and have been an NRI myself for the past 6 years. Through my personal experience, I have seen how challenging it has been to bank, invest, and manage my personal finances on an ongoing basis. Now, the current options with Indian banks and other financial institutions are very limited. And one thing that we have seen is, it offers a suboptimal experience. And I always wish that there was something better way to do this, but just like I have it for my US finances. With that said, I am excited to be building INRI with Nishat, which is an investment platform for NRIs or non-resident Indians for like us to invest in India. With our exclusive focus on the NRI segment, we are a first mover in this space. We are also dedicated to be building a one-stop platform for NRIs for multiple use cases in the future. Now, coming to today, in this webinar, we'll learn on investing in India. What are the opportunities that lies ahead, as well as taxation and compliance as a result of it. Now, I want to take a moment to introduce and thank our special guest, Jaideep Sangani, who is a CA with more than 5 years of financial expertise in NRI and OCI taxation. Thank you, Jaideep, for joining us today. To begin, I'll just pass it to Nishad to take us forward.
Thank you, Evan. So just quickly running through macro, I think a lot of us might be already aware, but for those who aren't, India is facing one of the strongest tailwinds in terms of macro. The growth rate forecasts are being exceeded. Nifty just this month reached its all-time highs and crossed 19,400. Index funds AUM have been growing at 30%, 130% CAGR consistently since the last 5 years. And fundamentals of India have also been improved a lot. Capex to GDP, like capital expenditure to GDP ratio has increased to 3.3%, which is a 2x sort of multiple in the last 7 years. All of this is to basically highlight that while historically the investment destinations were always US, China, India in that order, China with like being a geopolitical risk is no longer second, and US with its higher interest rate regime now also faces some headwinds in terms of equity sort of returns. And so this makes India as a fast growing emerging country a great destination to invest. Not just like, even if you're not planning to move back to India, just as a diversification bet as well. Yeah, next slide. However, as Hemant mentioned, investing in India has been typically very hard for NRIs. Anyone who has moved from from India to abroad, or from abroad to like back to India, knows that financial institutions, banks, brokerages, etc., while all of them say that they have like special relationship managers dedicated to NRIs, they don't do a great job. And also, once you move outside and you have been outside India for a few years, you also don't know what is the right place to start, what are the right assets to build your wealth in, and like the low trust environment that current financial institutions have created does not help to the problem. Secondly, while a lot of processes have improved for Indian residents in the fintech ecosystem in India. Um, there is still like a lot of physical paperwork involved for NRIs to invest in India. Like most notably being like the demat account, which takes at least 2-3 weeks to open up. And as we will see in during the course of the PPT, that changing demat accounts from a resident Indian to non-resident Indian, etc., is also very, very hard. And most brokerages actually don't sort of offer that. And to add on it, taxation becomes like a key issue, which is what we will talk about. Um, there is cross-border taxation depending on where you are. You will have compliances on in your resident country as well as in India, and like being compliant in both these countries has been hard historically. So that's why we've created INRI to solve for the global Indian diaspora, where we offer a platform which is fast and simple. The onboarding takes less than 2 days and completely online. There is curated portfolio based on your country of residence as well as your risk appetite and your financial goals. And to add to that, we provide complete tax and repatriation support so that you don't have to like sort of face fragmentation in terms of this entire investing process. Moving on.
Hello everyone, I am Jaideep Sanghani. I am a chartered accountant from India. My main practice areas have been international taxation and FEMA, and I work with clients in India as well as in US. I would like to thank Nishad and Hemant of INRI for this opportunity to address this topic, and of course for help taxpayers like you who are joining us today to have a better understanding of the tax and compliances. Today we will cover basic overview of specific tax areas. Note that today's topic includes income tax and FEMA is a very complicated aspect. Every situation will have a different set of outcome. But today what I'll try to do is give you a gist of what you need to take care and what can be done or what cannot be done so that you are aware and you know how to achieve your investment goals. Next slide, please. So I would like to bring your attention that discussions and materials in this webinar are not tax, legal, or financial advice. Before you rely on any of the information or content of this webinar, please consult a professional chartered accountant or a CPA before making any decisions. So let's start. Today, the topics that I'll cover is investments in mutual funds, listed shares, or stocks, as you call in the US, real estate, and bank accounts or term deposits. By the end of the session today, you will have a pretty good idea of FEMA provisions, including repatriation of funds from India and the taxation of income that is generated from your investments. So let's discuss the taxes for this compliances and overview of a non-resident in India. The first point of a taxation structure is residential status. So let's understand some differences that are there in the FEMA, that is the Foreign Exchange Management Act, which regulates investment in and out of India, and under the Income Tax Act. For tax purposes, the residential status in India, there are three options: that you could be an ordinary resident, you could be a resident but not an ordinary resident, or you could be a non-resident. Each of this status decides what level of income is taxed in India. Under FEMA, however, there are a different set of rules. So residential status under FEMA and under the income tax could be different for you. So FEMA will determine what you can invest, how you can invest, or if there are any restrictions. Income tax will determine whether your income in India is taxable or not, or whether your global income is taxable or not. Under FEMA, there are two main categories of residency. A person could be a person resident in India or a person resident outside India. Now, there is a third category, that is a person resident in India but not permanently resident. Those are for employees working in India. We will not cover that because of the nature of this webinar. Now, note that FEMA residents and income tax residents both are totally independent of each other. So you could be a resident under income tax, but you could be a non-resident under FEMA and vice versa. And combined reading of both the laws will help you understand what your situation is. Now, there is a link at the bottom of this slide that will allow you to calculate your residential status, whether you are an ordinary resident, not ordinary, or a non-resident in India. That said, as I said, residential status determines what income is taxed in India. For residents, global income is taxed. Residents, I mean ordinary residents. Ordinary residents, global income is taxed. Whether you earn it in India, whether you earn it in any other country, it is taxable in India. For non-residents, income that accrues outside India, and it should not be received in India. If you earn income outside India, you receive it outside India, it is not taxed in India. For not ordinary residents, that is the midway, the income that accrues outside India, basically you earn any income outside India, but if the business or profession is set up in India, then it is taxable in India. Now note that any income received in India, or if it is accruing or arising in India, it is always taxable. So if you earn income outside India, but you bring it back directly to India, you can though route it through your bank account in a foreign country, that would not be considered as received in India. But if you directly receive your income in India, then it is taxable. Whether you are a resident, non-resident, doesn't matter. In India, though, there could be no tax payable if your income, right now, let's talk about tax return filing. Even if there is no tax payable, Indian basic income tax exemption limit is 2,50,000 rupees. Now, even if your income is more than 2,50,000 rupees, there are situations where you would not have any tax liability in India. But that doesn't mean that you do not file a tax return in India. So if your income exceeds 2,50,000 rupees, you are required legally to file your tax return, whether or not tax is payable or not, doesn't matter. Now, since we have an idea of income tax, let's go to FEMA. FEMA basically works on regulations issued by the RBI. Now, these are notified either by the Reserve Bank of India or by the central government through its gazette. Now, what these regulations do is allow or restrict a transaction where foreign exchange is involved. Like I said, it works in two ways. Non-residents could be investing in India, that is an inward transaction, and residents who are investing outside India. So FEMA restricts or allows certain transactions based on what type of foreign exchange is coming into India or outside India. For non-residents investing in India, the terms OCI, NRI, and PIO, that is overseas citizen of India, non-resident Indian, and a person of Indian origin, these are very important as they decide what is allowed under FEMA to be done or if it is restricted. Investments under FEMA could be either repatriable investments or non-repatriable investments. Repatriable basically means that whatever original money you put in, original investment that you put in, could be freely remitted outside India. So that money will easily be transferred outside India without much compliance. Now, what is non-repat then? Non-repat is basically if you put some money in India and that money is not free to be transferred outside India. You can reinvest it in India after you sell your original investment, but you cannot directly transfer it. However, there are rules that allow transfer of non-repat money outside India, but we will be covering them later on in this webinar.
Thank you, Jaideep, for the quick introduction. So a lot of people in India invest in mutual funds. Mutual funds in India is a $500 billion industry and growing at over 8%, 7 to 8% sort of CAGR every year in terms of AUM. So obviously we will cover mutual funds first, and like Jaideep will walk us through the taxability for if you are invested in mutual funds as an NRI or OCI. Yes.
Yeah, so before we start taxation and FEMA, let's see how mutual funds are structured in India. So your mutual fund investments could either be an equity oriented mutual fund, which is the same as investment in a listed shares, or it could be a debt oriented mutual fund. Now, when I say debt oriented, it just means that it is not equity. Now, Also, the funds could be growth funds or they could be dividend funds. Now, growth funds give you return on your capital. Basically, you do not have a regular income, but the value grows. And dividend funds provide you regular income and have regular distributions as dividends. Now, income from sale of mutual funds are called capital gains. They could either be a short term or a long term, and your tax implication depend on whether it is short term or long term. Uh, Equity mutual funds are short term if you hold them for 12 months or less. For other funds, that is, they could be debt funds or they could be hybrid funds. However, the date of purchase is very important, especially this amendment was brought in by the recent Finance Act. So if you purchase your mutual funds before March 31st, 2023, then they would be considered short term if you hold them for up to 36 months. So up to 36 months, that is 3 years, your mutual funds are short term. But you must have purchased them before March 31st, 2023. Now, if you purchased in this financial year, that is after April 1st, 2023, they will always be short term. So there is no concept of long term for other mutual funds, that is non-equity mutual funds, if you purchase after April 1st, 2023. Let's talk about the tax rates. For non-residents, short-term capital gains from equity funds, it taxed at 15%. So that is a flat rate taxation, 15% on whatever gain you have. But from other funds, if it is a non-equity fund, the tax slab rate applies. So whatever your level of income determines how much tax you pay. Long-term capital gains from equity-oriented funds are taxed at 10%. But there is an exemption of 1 lakh rupees. And if the gains up to 31st January 2018, that is the notified date, till that date, there was no taxation on long-term equity-oriented funds or long-term shares. So gain up to that date is exempt. If there is a loss up to that date, that loss is also not allowed. Now, non-equity funds, that is debt funds or hybrid funds, are taxed at 10% without indexation if they are unlisted, or 20% with indexation. Now, this rates 10% with 10% without indexation and 20% with indexation are rates for all long-term capital gains, whether it would be from shares, mutual funds, real estates, anything. So these are standard rates. What indexation in India does, it allows you a benefit of cost inflation. So whatever cost inflation index is notified every year by the government, you get a benefit. So your basic income level is lower. Let's talk about dividends. All dividends from mutual funds are taxed at slab rate. So your taxable income determines what amount of tax you pay. These tax rates could be lowered by double taxation avoidance treaties with your residence country. So if you're a resident of USA, there could be a lower rate of tax. For non-residents, these transactions will also involve a tax deduction at source. So if you earned capital gains, it is more likely that you will have already paid the tax when you receive the funds in your bank account after sale. You may claim a refund if the taxes are over deducted, or you may be required to pay tax if you are into a higher slab and the tax deducted is a shortfall. Now let's go to the FEMA part. We are done with tax. So what is allowed and how it is allowed. So for NRIs and OCIs who are investing into India, like I said, there are two types of investments, repatriable and non-repatriable. Now the choice of investment is with the investor. So as an investor, you can do a repat investment or you can do a non-repat investment. That is up to you. But how to do it is determined by the FEMA regulations. So repatriable investments can be done through inward remittance from your foreign bank account, or from your NRE account, or from your FCNRB account. Non-repat investments can be done through your NRO account as well. So in addition to these three forms under repat, you have an option to invest from your NRO account as well. Now, sale proceeds from repatriable investments could either be credited to NRE, FCNR, NRO, or it could be either remitted outside India to your foreign bank account. But in case of non-repat investments, they can only be credited to your NRO account. I think this is a basic idea of FEMA. Over to Nishad and Hemant, who have a beautiful product for investing into India. And this would solve many of your issues and confusions.
Yeah.
Sorry, I think I was on mute. Thank you, Jaideep, for sharing a quick overview on taxation on mutual funds. Since we are the same topic, we'd like to bring the audience attention to INRI, which is investment platform for NRIs, as you mentioned, and mutual fund is one of the first asset class that we are starting with. We already have a functioning product and live customers. So I just want to take you to our website. We also have a limited offer running right now. If you invest by July 31st, then you have lifetime free access. This is our main website. You could start. We also just want to mention, we are also backed by Y Combinator. This is one of the global renowned VCs, and they've invested with us. So quickly get started, one could get started at sign in. And so this is the sign in page. You could sign in with your Google account or through email. So let me choose my Gmail account. So this is the first step. So this is the onboarding you could start with. So I'm based in the US, so I will choose United States. There are three options what could start with. We also provide taxation and NRI and our bank account opening. So if you are looking for that, we do have you covered. Yeah, or to get started investing in India, you could also begin here or begin in either of these cases. So let's say I start with investing in India, and let's say I'm interested in mutual funds, real estate, and fixed income. So this is my PAN I've already put in. So I could easily check my KYC verification in less than 10 seconds. So we'll do this live check right now. Yeah, so I think it's compliant. So, let me get started. So as you start, as I see, like my PAN is already compliant, and there is an onboarding process for this. So one could go over and begin with this. Apart from that, we have personalized our platform to a lot of the different investors here. So you could start with constructing your own portfolio. So for example, you could put in your risk comfort, time horizon, your date of birth, and asset options. And this would customize a portfolio for you. So if I click on customize portfolio, I'm able to see a selection of funds that I could invest in. We would provide more flexibility into choosing these funds. But you could basically get started and adding to cart. So let's say if you add to cart, you could get started by just quickly investing in these 4 funds. So we have specified a nominal amount here, but you could always update it as you prefer. There is obviously an onboarding that you need to do before you place orders. If you are a more savvy investor and you want to choose your own fund, you could do that as well. So if you scroll down below, you are able to see different schemes here in terms of benefits. So if you are interested particularly in low cost index funds, then you could look at these, or active funds, or if you are looking to save taxes and invest in ELSS funds, that is also an option. So let's say if I am interested in tax, right? So if I click on view more, I just go down and I see all the ELSS funds that are being listed. And if I really want to look at one of these funds, I could just click on it and see more details here. So I can see, okay, this is a fund, and there is a fund objective. This is what it is returning in the past, and these are the top holdings here. Great. Let's say once you get invested, how would it look like for you, right? So if I have invested, this is what my portfolio looks like. So it says that, so I invested back long ago, like 3 months ago, and since markets are already up in India, I've been getting good returns of about 11%. So this is what I had invested in, and it also shows me, what's the equity and debt pie for me looks like, and these are my funds, and this is what I purchased at. There is a profile section where you could look at more details into the documentation that you provide with us. You could look at the orders, documents, bank accounts, and different things. As I mentioned, we also do KYC. So if your KYC was not compliant, you could come here and update your KYC anytime, because we do see that KYC is a big problem with a lot of NRIs, because they get outdated and are being asked to do multiple times. So we offer this KYC digitally and paperless. Thank you. I also wanted to show one more thing. So since you may have more questions here, we have launched a new product which is called NRI GPT. This is a way to kind of look for your questions very easily by just typing in here and saying, what you are interested in. So if I am interested in investing in India, okay, so there was a typo. Okay, so it corrected automatically. So you can see that, there is some prompt to begin with, but we also provide readable blogs that you could go into. So all of this is powered by OpenAI, which is the leading LLM provider, or you can say generative AI in the world. So we have detailed blogs on multiple topics here, and you could just look at your leisure time and grow your knowledge. So back to Nishad and continuing the presentation. Thank you.
Yeah. Thanks, Hemant, for the quick demo. So before that, Jaideep talked about NRO, NRE, FCNR accounts. And of course, like the basis of getting access to the financial ecosystem in India for an NRI are these types of NRI accounts. So we will first cover what they are. Jaideep will give a quick overview, and then we will also cover the taxability criterion for each one of them. Yeah.
Yeah. So like Nishad mentioned, we will cover three main types of accounts that could be opened by a non-resident in an Indian bank. So there is an NRE, FCNRB, and an NRO account. NRE is a non-resident external, FCNR is foreign currency non-resident account, and NRO is a non-resident ordinary account. There are also other types of accounts. One of them you may have heard of is an SNRR account or an RFC account, but those accounts are for specific purposes or not for non-residents. Resident foreign account, as it says, it is for a resident who wants to keep money in foreign currency. Now, let's look at these three types of accounts and what are the specific points that you need to look at. So FCNRB account cannot be opened by cooperative banks. So you could have an NRE or NRO account with a cooperative bank, but FCNR account is not allowed. Why it is not allowed? Because cooperative banks do not have the power to trade in foreign exchange. So they cannot obviously open a foreign currency account, that is FCNR account. Also foreign currency non-resident, so FCNR, as it says, it could be any foreign currency which is freely convertible, while NRO and NRE accounts are in Indian rupees. You may also see here that NRE and NRO accounts could either be savings account, they could be current account, they could be fixed deposit, recurring deposits, but FCNR is a term deposit only and it has a specific life. So it could be from 1 to 5 years only. For repatriation purposes, the funds in NRE and FCNR are basically considered to be outside India. So they are easily repatriable. However, NRO account is the route for all your non-repat investments. So whatever non-repat investments you do, those would be from your NRO accounts. So government has a strict restriction on remitting funds outside of the NRO. So if you want to remit funds, then you have to prove that tax has been paid on the income or that income is was from a repatriable investment. So from NRO, only current income is basically allowed to be remitted outside India. For all other funds, like apart from your income, you will need a documentation, and most of the times bank would ask for a CA certification, popularly known as Form 15 CACB, to transfer your funds from your NRO to your NRE or from your NRO to a foreign account of yourself. So that is a compliance part. Now, yeah. So let's look at taxation of the interest for the non-residents. As you see here, NRE account has a specific provision that is linked to FEMA. So if you are a person resident outside India, that is a non-resident under FEMA, then your NRE interest income is not taxed in India. However, if you become a resident under FEMA, then your NRE interest income is taxable in India. Income from FCNR account of a non-resident. Here non-resident is under the Income Tax Act and not under FEMA. So FCNR account interest of a non-resident or of a person who is not ordinary resident, that is also exempt from tax in India. Basically, foreign currency interest is exempt if you are a non-resident or not an ordinary resident. However, you will still be required to pay taxes in your home country. So though this interest is not taxed in India, either from your NRE account or from your FCNR account, you will be still liable to pay taxes in your home country, subject that your home country follows a global system of taxation for residents. Now, interest from your NRO account or interest from your FCNRB account to a resident Indian, so an ordinary resident, is taxable. For NRO account, anybody, whether you are a resident, non-resident, doesn't matter, interest is taxable in India. For FCNR, it is only taxable if you are an ordinary resident.
Just one point on the taxability of NRE accounts, and we have seen a lot of sort of NRI queries coming to us saying that they would want to invest, like put deposits in NRE accounts because it is not taxable in India. While that is true, as Jaideep mentioned, unless you are living in a tax-free country, you will be we will have to pay the tax in that country of residence. So do be mindful of that while you are calculating your FD returns, etc. As well. Just as a quick stat, there is $140 billion of NRE deposits in India currently. And I'm sure a lot of it is there because people are also thinking that they will not get taxed, but they owe tax liabilities in the resident country. So please be aware when you sort of take these financial decisions. Thanks. Yeah. So we can now move on to, a lot of people are active sort of investors and prefer like owning shares themselves. Generally, unless you are an expert investor, this does not beat index. So like in terms of historical returns, but if you do sort of own shares or want to own shares of blue chip companies or otherwise, there is taxability for that as well. And there is also a lot of sort of pain in terms of onboarding, which we will also cover. But let's cover the taxability part first. Yeah, Jaideep.
Yeah, so I just forgot to mention something in the interest taxation part. The tax rate for the interest is as per your ordinary slab rate in India. However, if you are living in a country that's a double taxation avoidance agreement, there could be a lower rate at which you could be taxed. That you will have to mention in your tax return in India. Okay, let's go ahead and now look at FEMA compliances for investing in listed equity on the Indian stock exchanges. Like Nishat mentioned, you will need a non-resident demat account, and expatriates from India may have a resident demat account already, but that generally is not convertible to a non-resident account. So you probably will need a new demat account and transfer your holdings to a new account. Most people, however, continue investing through resident demat accounts, which is a clear violation of the FEMA provisions. So if you do that, then it is a violation and you need to convert to a demat, that is a non-resident demat account. Now, for investing in shares, how can you bring the funds to India? To invest on repatriable basis, you can bring funds directly to your brokerage account by inward remittance or from an NRE account. For non-repat investments, you can bring funds from either NRE, FCNR or NRO accounts or directly from your foreign account as an inward remittance. Sale proceeds always net of taxes. So sale proceeds, whatever you sell, whether it is a mutual fund, whether it is a share, whether it is your interest income or dividend income, it is always repatriable after taxes. Now, sale proceeds after taxes of repatriable investments gets credited to NRE account, or you can take it out through outward remittance directly from your brokerage to your foreign account. For a non-repat investment, they will get credited only to NRO account. Like I mentioned when I was explaining the bank accounts, NRO accounts are the route for non-repat investments. So if you invest on non-repat basis, sale consideration or any income will generally be credited to your NRO account only. You cannot not allow it to be credited to your NRE account in any situation. Now, when we talk about non-repatriable investments, though the investment is a non-repatriable investment, current income, that is income on which you have paid tax from that investment, is always remittable outside India from your NRO account. You may have to prove it to the bank that this is income on which tax has been paid by way of a certification, like I said. But there is also a $1 million USD 1 million scheme for remitting non-repatriable investments or any other funds that you have outside India. This is applicable for NRIs and OCIs and for certain other persons, but those are specific conditions. So for NRI OCI, you can remit up to USD 1 million out of India for Indian financial year. This limit is for Indian financial year. So from April to March, you have a limit of USD 1 million. Now let's go ahead and talk about the taxation part. So non-residents are taxed on equity-oriented mutual funds. We already discussed that, and listed shares. Basically, both the investments are mirrors. So for taxation purposes, if you invested in an equity-oriented mutual fund or you invested in a listed share, the tax structure is identical. So short-term capital gains result when you have held your shares for less than 12 months, taxed at 15% if they are sold on the stock exchange. Long-term capital gains are taxed at 10%, again, 10% without indexation. It's the same thing again, up to January 31st, 2018, India did not tax long-term gains. So if any gain is there or if any loss is there, that gain is exempt and that loss is disallowed. Dividends from equity shares are taxed at slab rates. So the slab rate determines your tax rate. Same thing again, tax deduction will be applicable on gains and on dividends. Again, double taxation agreements with various countries could lower that tax rate. That is the same over here as well. Now let's talk about real estate. So we have done all the movable. Now let's go to immovable properties, investment in real estate. So under FEMA, there are two types of real estate that has specific regulations. It could be an agricultural property, that is agriculture land, farmhouse, plantations, etc. And it could be a non-agriculture property, basically covers everything other than agricultural property. There are certain types of transactions under FEMA that specifically define what you do, and these are the words used in the regulation. So if you purchase, it may be referred to under FEMA as purchase or acquire. You could inherit a property, you could sell a property, you could gift a property, or you could transfer a property. Now transfer includes sale or gift, both under FEMA. So what is allowed under FEMA for immovable properties? Hemant, can you change the slide? Yeah. So what is allowed under FEMA for NRIs and OCIs is you can acquire a property for personal use or for holding it as an investment. You can, in most cases, sell and repatriate proceeds outside India. For agricultural property specifically, once you become an NRI or an OCI, once you are a non-resident under FEMA, you can only inherit agriculture property. Note that you cannot buy or acquire agriculture property after you become a non-resident. Now, these immovable properties, you can rent them out. You can repatriate the income that you earn after paying applicable taxes. In specific situations where one spouse is an NRI or an OCI and the other spouse is neither an NRI nor an OCI, in that case, they can jointly own one property or buy one property. This is a specific situation and it is only allowed for one non-agriculture property. Now, there is no limit under FEMA for acquiring whatever number of properties. You can invest in any number of real estate properties. That doesn't matter. Now, what is not allowed? So you cannot do real estate trading. Basically, you cannot just keep on buying properties and selling properties in the sense that it is a business. So real estate trading is specifically not allowed under FEMA. Or you cannot deal in transferable development rights or TDRs. So those are basically land rights to develop a building or to expand a building. Now, there is a specific restrictions on non-OCI and people of certain countries that are listed here. You cannot buy or transfer property without RBI approval. They can only do it on lease. So specific countries are restricted. If you are a citizen of these countries and you are not an OCI, then there is a restriction here. So now we are done with the investment part. Let's move on to tax. So most of the real estate properties would have either a rental income or a capital gains income. Rental income from land or building, basically real estate, is taxable under the head of house property. We'll see the computation how to determine income in the next slide. However, in India, you may note that actual expenses are not allowed. So India has a threshold deduction, that is a 30% standard deduction. Actual expenses will not be allowed from your taxes, except for these two, the municipal taxes or property taxes. That is allowed for rented properties. So if you rent out a property, municipal tax will be allowed as a deduction from your rent income. Or second is the interest on borrowed capital. So if you take out a loan to acquire a property or to construct a property, then that capital, that interest on that capital is basically allowed as a deduction from your rental income. It may be allowed as a deduction even if you don't rent it out. We'll see that later. So there could be a pre-construction interest, so before your property gets built, or it could be a post-construction interest. Now, pre-construction interest up to the prior year. So let's say your property gets completed in 2023-24. So up to March 2023, that the year just ended, till that period, whatever interest is there, it is called pre-construction, and it will be allowed over next 5 years. So it will be allowed in equal installments. So whatever interest was there till that date of the last year, divide by 5, it will be allowed every year. Post-construction interest will be allowed in the year to which it pertains. A specific deduction under ATC is also allowed for principal repayment of housing loan. Note that this is for residential property. Interest you get deduction under the normal provisions. So for the principal that you repay of the loan, a section ATC deduction is available. Before we go into the computation of taxable income, so there are three sort of properties that are defined in tax law. One could be a self-occupied property. In India, it is restricted to 2 houses. 2 houses, you can say that you are occupying for yourself. But this would generally not be the case if you are residing outside India. So it couldn't be a self-occupied property when you are residing outside. Second is the let out or rented properties. So even if you are willing to rent a property, but it remains vacant because there are no tenants or you cannot find tenants, then it is considered as a let out property. And the third situation is a deemed let out. So this is a deeming provision. So you let's say invest in a property. You are non-resident, so you are not residing in India. You are not occupying that property, or it could be a commercial property, right? But you are not renting it out. So India will tax that notional income, even if you are not actually renting it out or earning any income. So there is a notional portion of income that is taxed in specific situations. Now let's go to the computation. Hemant, can you hear? Okay, so rental income is basically a gross annual value. This is the legal term. Let's see how it is in the layman terms. So rental income is basically whatever rent that you accrue or whatever is receivable by you. If you didn't get a recovery, let's say your tenant says, I'll not pay this amount. So it is basically a debt that you cannot recover. So you can deduct that amount of rent. But if you, let's say, recover that rent in a subsequent year, it will be added back to your income. Now, this is when you have actually rented out your property. Now, let's say in the case of deemed let out properties, you will not actually rent out the property, but the government will consider a notional rent. That notional rent is based on similar properties in your area. So that is deemed to be considered whatever you earn. So even if you don't actually earn anything, you will still be liable to pay taxes on that. Now, what is allowed as a deduction? So the first two rows of this table are for rented properties or for deemed let out property. So in that case, you are allowed a municipal tax or property tax that is actually paid during the year. Now, when you see the third row, it says net annual value. So after deducting the taxes, what you arrive is a net annual value. But if you are living in that property or it is a self-occupied property, then the NAV will be nil. So you'll start at 0. Then you have a 30% deduction that I said, a standard deduction or a flat rate deduction, no actual expenses allowed. Whatever your NAV is, you just get a 30% deduction. Less interest on loan will be your income under the head house property. So it could be a loss as well. We'll see loss in the next slide. But if it is a positive, that is your taxable income. Now this taxable income is at your slab rates. There are no specific rates for income under house property. Now let's look at what happens if there is a loss. So loss could be there for self-occupied properties due to interest, or in case of let out properties due to municipal taxes, or it could be due to interest again. Now municipal taxes, loss due to municipal taxes is rare, because if you are letting out a property, you would probably be recovering the municipal taxes at least. Right? Now, up to what limit is the loss allowed? The loss is allowed up to rupees 2 lakhs. So if the loss is more than 2 lakhs, you just lose it. Now, this loss basically means that your interest on borrowing is more than 2 lakhs in excess of your rental income. So you lose it if the loss is determined to be more than 2 lakhs. Up to 2 lakhs, it could be offset against your other income. So if you have interest income, you have capital gains, any other income that is taxable in India, you can offset up to 2 lakhs against this loss. If it is not offset, then what? Then it is carried forward up to 8 years. But in the future years, you can only offset against house property. So you cannot offset it against interest income, against dividend income, or against your capital gains. So in the next year, you can only offset it against your house property income. Now that is about rental income. Now let's look at capital gains. Now capital gains for real estate, that is land and building, it is short term if you hold it for less than 24 months and long term if you hold it for more than 24 months, that is 2 years. Now what is taxed? Sale consideration minus actual expenses for transfer of capital asset. Then there is a cost of acquisition and cost of improvement. Cost of acquisition is your purchase price. Cost of improvement is your furnitures, or if you did any substantial improvements to your property, renovations, that is cost of improvement. Now, for long-term capital gain, there is an indexation provision. Like we mentioned when we discussed mutual fund, this indexation is optional. Indexation, you have to determine two calculations basically. One is without indexation and one is with indexation. So 10% of your gain without indexation or 20% of your gain with indexation, whichever is lower is your tax. For short-term capital gains, your tax slab rate determines how much tax you pay. Now, many of non-residents must have heard that there is a specific exemption in India if you sell residential property or a real property, and then you invest that fund into a different property or a new residential house. Now those exemptions are under section 54 series of the Income Tax Act, but for non-residents we generally don't advise taking those exceptions. That is because where you live, your home country is obviously going to tax you on your global income, and you will have to pay tax in your country of residence. So instead of taking the exemption here and paying more tax in your country of residence, you just pay tax here in India without taking any exemptions and take the credit of that tax in your home country. So while you sell real estate, please also make sure that you plan for your taxes in your home country. One another situation arises where there is a sale of agricultural land. Now, the agricultural land sale could be exempt, it could be taxable. The definition of agricultural land for exemption purposes is that if it is located near a municipality or near a city, then it would be taxable. If it's located in a village which has substantially lower persons residing, then that would be exempt. I think this we have covered mutual funds, stocks, and real estate and bank accounts. That should be enough. If you have any questions, please ask it. Nishad and Hemant, please forward those questions to me, and we can
Yeah,
answer them.
so
We have around 5 minutes.
there is one question in the Slido link. Let's cover that quickly, actually. Uh, I'm a UK citizen and OCI card holder. I have cash savings in NRO account. The interest on savings is taxed. I don't have any other income. Can I claim tax back?
That depends on whether your interest income is above the threshold of taxation or not. So if you have a higher interest, then you may not be able to claim back your tax as a refund. But if you don't have any other income and your income, let's say your taxable income is less than 2,50,000, then probably you can file a return in India and claim your taxes back.
Got it.
Sounds good.
There's one more question from the chat by Arjun. So, what is the tax implication if we have our parent as the primary owner and NRI co-owner of a residential property which is given on rent? So, there's a rental income on a property which is co-owned by the NRI and let's say the parent. And the parent is the primary owner.
So the implication depends on how funds were invested, who put in the money. Let's say you didn't, as an NRI, didn't put in any money to buy that property, and your entire proceeds basically were invested by your parents, and you just are a owner for namesake, let's say. If that is the situation, your parents would be entirely liable to tax. If you have put in equal money, you and your parents could be equally liable to tax. Or there could be a situation where the agreement mentions the percentage of ownership of each owner. So generally, I have not seen that case in most agreements. You just mention names, you don't mention percentage unless it's a business deal. So if you have that specific percentage of ownership mentioned in the agreement, that percentage of income, you are liable and your parents are liable based on that.
Got it. Thank you. That was a great question. We have a few more questions from the chat, so we'll just continue from there. What happens to the FCNR account if NRI returns back to India and convert his status to ordinary resident?
Yeah, so FCNR account basically can be held up to the date of maturity. So you have an FCNR deposit of 3 years. You come back to India after 1 year. For those remaining 2 years, that FCNR account can stay. But once that deposit matures, it will be converted either to a RFC account, or the funds will be converted, basically transferred to your NRE or NRO or your resident account if you are, you have become a resident permanent.
Thank you. Next question on ITR filing. So how is it different for an NRI compared to a resident Indian, and which forms would need be applicable here?
So NRIs have simpler filing in India. The tax forms for residents and non-residents are pretty much the same, but the portions that you need to fill in reduce substantially because you don't have to report your global income. So whatever income you have accrued or received in India, that is only disclosed in your tax return, in addition to your bank accounts and certain other details. Otherwise, the filing is simpler for NRIs because of non-reporting of foreign assets and everything. You may need to calculate your number of days basically stay in India during last 4 years, or even go back to last 10 years to appropriately determine your residential status. Now that was not part of your income tax forms earlier. I think, for instance, last 2 years, you have to mention how many days you were present in India in the last year and in the last 4 years. And you have to mention your foreign, like we in India, we have PAN, US has social security number. You have to mention your foreign identification number in the tax return.
Got it. Next question on if I sell property in India and capital gain tax was paid in India, how do I get tax back or credit in USA for this tax that I paid in India?
Each country has its own set of rules for getting credits. Even the double taxation avoidance agreements determine how much tax will you get as a credit, and the local law will also determine. So this is a very complicated answer to have on this forum, but you generally would get a tax credit. The timing could be different. The amount you may not get 100% or you may get 100%. That entirely depends on your situation and your tax liability in your home country as well.
Great. Thank you. We'll take few more questions because we are short of time. So I think just two more to in the interest of time. So 401k money in US for Indian resident would be taxed in US or India. Will there be any capital gain tax? So this is money for an Indian resident. Let's say one has moved back to India but has a 401k money in the US.
So once you become a resident in India, your global income is taxed. So there is no exemption for 401ks or IRAs or anything in the US. You will be taxed on your global income, whether or not you are taxed in US. So even if your 401k is not taxed in the US, you will still have to pay tax in India. But that is for a resident. If you are still a non-resident, obviously it doesn't apply.
Okay, that's interesting. I think I didn't know that. I should also know about this as an NRI. Okay, I think this last question. So offset my capital gains tax on sale of property as an NRI invested in REC bonds. Now I'm generating annual interest on REC bonds. Is that interest income taxable?
I think REC bonds interest income is specifically exempted. I'm not sure of that, but I think it is specifically exempted from tax just because it is, as a promotion by the government to offset your income tax liability from capital gains.
Got it. Great. So I see we have a lot of questions and I really like the interest, but in the interest of time, we like to move. We will provide an email for all of you to reach back to us if you have more questions. So feel free for that. And we'll just move ahead. Nishad, please take over.
Actually, let's go to that slide first, and then we can cover this slide. So that, so three important announcements, I think, before we all depart for the day. One is India tax filing season is here. So if you, based on all of this information, if you actually have some tax liabilities, please don't forget to file your taxes. If you have any more questions or want help in tax filing, we can help you there. Jaideep, as you saw in the webinar, is an expert here. So do write to us at tax@govindie.com. And these are Jaideep's credentials as well if you want to reach out to him. And like on going back to sort of one of the key takeaways for this from this entire webinar is investing in India has been really hard because of reasons related to investing and reasons related to tax. We simplify this completely, and both Hemant and I are personally excited to be solving this problem. I have been in India, and I am deeply interested in personal finances related to India, and my motivation here is to see India grow, and of course see my wealth grow through that. And Hemant has been an NRI. He has faced a lot of these problems himself. He also believes equally strong in the India story and has been even a derivatives trader in India since the past 5 years. We think that the moment of reckoning is here. People who I know, like a lot of people who are older would say that we saw the same during India shining, etc. But I think this time it might truly be different. And so do take opportunity of this entire sort of platform. It's a platform that we have built mostly for people like ourselves. So, and there's a lifetime free offer if you invest before 31st July. Prices increase for the platform after that. And finally, if you like what we are doing, this is the second webinar that we have conducted on tax. Our first webinar was on specifically US taxation for NRIs, OCIs, and we have posted some snippets from that as well on our YouTube channel. But if you want to be updated about our future events, etc., do join the community. There is a QR code on the last slide of this presentation. Thank you, everyone. Thank you so much for taking out the time. It was great to see people all over the world sort of joining, and we are available if you have any other questions.
Yeah, thank you, Hemant. Thank you, Nishad, for this opportunity. I think it was great. And do reach out. I think you already have the email. Do reach out if you have any queries. We are, glad to solve them. Thank you and have a good day. Have a good night, wherever you are in the world.
Yeah, thank you, everyone. Really love having you all, and have a good time back at your home. Thank you. Bye.
Thank you.